Fidelity. And Jurrien, it's great to have you on the show. Welcome.
Good afternoon, Morgan.
So let's start right there, because one of the things you say in your notes is that momentum begets momentum. And so you see us moving higher from here.
Yeah, so, obviously the S&P is making new all-time highs, one of the fastest ever recoveries from a 20% decline, only bested by the 1998 reversal in late 2018. So very, very impressive V-shaped recovery. And when an index or a stock market is, rising over time, has a rising trend line, is making new highs, that momentum tends to, like you said, beget more momentum. The question, of course, is what is the price we're paying to be long that index, right? And so the price to free cash flow is 37 times. It's in the top decile of all time. So it's a question of price and value. What do you pay? What do you get? That question is a little bit less urgent when you go overseas. And if you look at, for instance, the MSCI All Country World Index ex-US, that is also making new highs, whether it's expressed in dollars or in local currency terms. So that's a very bullish chart, and it doesn't have that valuation overhang that the U.S. has. So it's nice to see global participation for investors, whether you're a stock picker or an asset allocator. It's nice to be able to fish in a big pond with a lot of fish rather than a very narrow pond, and we have a pretty big pond right now.
Okay, so is the read-through there that if you have money to work with right now, maybe you look globally or internationally and wait for a pullback here in the U.S.?
You certainly could do that, but the broader point is that we're in a more level playing field now. For the last 10 years, if you were not in the U.S. or in large cap tech or the Mag 7, you were really missing out, and that was the only game in town. And so what's nice is it's no longer the only game of town. So whether it's for geopolitical reasons or trade or what have you, if the playing field is more level, it just creates more opportunity to kind of spread our assets more broadly around the world to get both the growth and the valuation side.
We've been talking so much about the Fed, especially with all the rhetoric, shall I say, back and forth between the White House and Fed leadership, or maybe it's more one-sided this week. But I do want to get your thoughts on what we're seeing here in the U.S. in the bond market, and specifically the impact that the tax and budget bill could have on that picture, as we have had a yield curve that continues to steepen.
Yeah, so this is the other elephant in the room, right? So we all know the whole tariff story, and the market, repriced itself very, very quickly in April from expecting a big left tail event to now expecting a right tail event. And we got some of that because the tariff story has died down a little bit, not a lot, but also we got the big, beautiful bill, of course, which acts as another fiscal impulse, but it carries with it, a cost, and that is that there's now $5 trillion of extra deficits to be funded, and there's no low-hanging fruit like we had in 2023 under the previous Treasury Secretary, where Janet Yellen could just switch from long-dated bonds to short-dated, and there was $2 trillion of reverse repo sitting at the Fed that can just be tapped into without any cost, without any effect on reserves. That's not really the case anymore. And at the same time, the 10-year Treasury is at 443. It was near 450 yesterday. As I like to say, nothing good ever happens after midnight, but also nothing good ever happens above 4.5. And at above 4.5, the Treasury bond market, which is supposedly the risk-free asset, is very competitive with equities, which also yield a 4.5% earnings yield. And so when you go back into periods of history where yields are competitive and relatively high, the stock market has to pay attention to that when yields go up. And so if yields do go up above 4.5 towards 5, not a prediction, but it could happen with this fiscal, the load that we have to bear, it's going to put some pressure on equity valuation. So that's definitely the other side of the coin here.